Hey everyone, today we're diving into an incredibly powerful and surprisingly simple investing strategy. It's so effective that Warren Buffett himself says it's the way to go. And the best part? It's designed to be totally stress-free. So, let's get right into it. All right, so here's our game plan. We're going to start by talking about a really common trap that so many of us fall into. Then, we'll look at the simple, elegant solution from one of the world's greatest investors. We'll break down exactly why it works so well, and then we'll get practical and build out a plan you can literally start today. Think of it as a roadmap from financial frustration to real, disciplined success.
First up, let's talk about a painful cycle that might feel a little too familiar for many of you.
Does this sound like you? You see a stock shooting for the moon, so you jump in near the top, and then it dips, you panic, and you sell. This is what's sometimes called the leak cycle, where smaller investors just keep getting cut down. You know the feeling, right? It's this exhausting roller coaster of buying high on hype and selling low on fear.
Or hey, maybe this is you. You buy a stock because it has this juicy dividend, but then you watch its actual price just sink. And it sinks by more than you ever got in dividends. For busy professionals like us who don't have the time to become full-time market analysts, trying to pick the right stock often leads straight to this dead end. So, how do we get off this crazy ride? Well, thankfully, there's a simple answer, and it comes from one of the investing GOATs, the greatest of all time.
And you gotta love the irony here. Warren Buffett, the guy who literally built a massive fortune by meticulously picking individual companies, tells the rest of us not to do that. His advice is incredibly clear. For most people, the best move is just to own the whole market through a simple, low-cost index fund.
So what exactly is index investing? It's actually beautifully simple. Instead of spending all your energy trying to find that one magic needle in a giant haystack, you just buy the entire haystack. That's it. You stop betting on your ability to pick winners, and instead, you place a long-term bet on the growth of the overall economy.
Okay, sounds easy enough, right? But what's the magic behind it? Why is this strategy so powerful over the long run? Well, it really just comes down to two absolute pillars of success. Let's break them down.
So on one side, you've got these actively managed funds. A manager tries to pick winning stocks for you, and for that privilege, they charge you high fees, often more than 1%. On the other side, you have index funds, which just track the market for a tiny, tiny fraction of that cost. And that fee difference, believe me, it doesn't sound like much, but over time it's a huge deal. That extra 1% fee can eat up almost a third of your potential gains over your lifetime. It's wild.
And this chart just says it all. Those high fees are like a constant, slow leak in your investment bucket. Over decades, that tiny drip turns into a massive amount of wealth that you just lost. Index funds plug that leak and keep your money working for you, not your fund manager.
And pillar number 2 is the power of diversification. When you buy the whole market, you're instantly protected from any single company blowing up. You automatically avoid those landmine stocks. You're not making a risky bet on one industry. You're just capturing the steady, average growth of the entire economy.
Okay, so we've got the why down. Now for the fun part, the how. Let's look at how you can actually build a practical portfolio with some real, concrete options. Here are some fantastic, super accessible examples. For an investor in Taiwan, a great place to start is the 0050 ETF, which tracks the 50 biggest companies there. Simple. But if you want even more diversification, you can easily expand your horizons to own the entire US stock market with something like VTI, or hey, why not the whole world with VT? All right, now listen up, because this next part, this is honestly the most critical piece of the entire puzzle. Your success with this has less to do with which fund you pick and everything to do with your mindset. You have to learn to conquer your own worst enemy, which, let's be honest, is usually our own emotions. And your secret weapon for this is a technique called dollar cost averaging, or DCA. It's so simple. You just invest a fixed amount of money at a regular time, say every single month. By doing this, you take all the emotion and guesswork out of it. The system just naturally forces you to buy more shares when prices are low and fewer shares when prices are high. It's like a built-in buy low strategy that runs on autopilot. But what happens when the news is screaming crash and the market is just a sea of red? Our natural instinct is to scream, "Stop! Get me out!" This is probably the biggest psychological trap that trips up investors.
But here's the reality. This is the mindset shift that will make all the difference. A market crash isn't a fire, it's a fire sale.
For a disciplined long-term investor, a big downturn is a massive opportunity. It's a chance to buy all those great assets at a huge discount. This is where real wealth is actually built.
Okay, let's tackle another common myth, especially in places where people just love getting those dividend checks. A lot of people think that buying a high-dividend ETF is basically the same thing as index investing.
But the real measure of your wealth growing isn't just the dividend. It's something called total return. That's the dividend payout plus the growth in the actual price of your shares. Sometimes, when you chase those super high dividends, you end up sacrificing price growth. A broad market index fund is designed to capture both, maximizing your total return over the long haul.
So, it's really important to have the right expectations here. This is not a get-rich-quick scheme. Not at all. Historically, broad market indexes have returned somewhere around 8 to 10% per year over long periods. This is a slow wealth strategy. It relies on the absolute magic of time and compounding to do the heavy lifting for you. We've covered the why, we've covered the how. Now let's bring it all home with a simple, powerful call to action so you can make time your #1 ally, starting right now.
And honestly, it is as simple as 1, 2, 3. Step 1, decide on an amount you can consistently invest every single month. Step 2, pick a broad, low-cost index fund that fits your goals. And step 3, the most important one, automate it. Set up a recurring investment with your broker and just let the system do its work. Set it and forget it.
So, I want to leave you with this final thought. This whole strategy isn't just about growing your money, it's about buying back your time and your mental energy. What if you could confidently build your wealth in the background, freeing you up to focus on what really matters, your career, your family, your life, without all the stress of watching the markets every day? That, right there, is the real freedom that index investing can give you.